Hey guys, Toby Mathis here with Infinity Investing. Today we're going to talk about, should I be buying the dips in the market? So we're going to dive right into that. Before you do that, if you could click on the like and subscribe, I'd really appreciate it so we know how many people we're sending this out to. I know that we reach a huge audience, just generally speaking, our stuff gets shared, but I do like to see it on our YouTube channel as well. Now here, let's dive in. First off, with this market, it's been doing a lot of the roller coaster, right? So you're going to hear a lot about, hey, the market's down, this is a good opportunity to buy, etc. I don't like following conventional wisdom out there or what the pundits are saying or the talking heads on TV, because quite often they're focused on the wrong things. Let me give you an example. Most of the time, people are talking about the growth of a company or gains in the market. They're talking about a hypothetical price based off of what a share or a group of shares has been selling for. So what the company shares have been selling for, and saying, if we sold the entire company, we would still get that price. And as we know, that's not the case. When you're valuing it based off of that, that assumes that somehow I could lock in every share price. And we know that if somebody started dumping the stock, the price is going to drop. So that's always a fallacy to me. What I like to look at is, what am I going to receive in the future for owning that company? And so I like to look at the cash that I'm going to receive, right? If I'm going to buy a house, I'm not so interested in how much the house is going to be worth in 2 years. I'm interested in how much I am generating, how much cash I am generating because I own that house. For that very reason, my personal view is that your personal residence isn't really an asset because it doesn't produce anything. In fact, it's a liability because it's taking money out of your pocket. Same thing with cars, boats, things. Hey, it may go up in value, but it's not really an asset. An asset feeds you. An asset produces cash. So when I'm looking at the stock market, when you have a pullback, I'm starting to say, is it cheaper for me to buy that cash? In other words, if I'm going to buy a cash flow, so I could sell you, hey, I could sell you a piece of paper that pays you $100 a year, every year, forever, right? A perpetual income stream. That has a very good value to me because I can say, hey, I know what's coming into the future. Now, it's kind of like you go into the bond market. People like the certainty of saying, I know exactly what I'm going to get. When you go into the stock market, you don't get that, right? So you're going to try to get as close as humanly possible to being able to say, this is what it's worth. So what do we look at? We look at history, we look at the company, we look at what its cash flow is and all those things. And we can start saying, hey, they historically, for the last 50 years, have been paying out this percentage of their free cash flow in the form of a dividend. They're profitable every year. They're kicking it out. And we can look at the company and say, hey, you know what? That's going to keep going on for 100 years, 200 years, 300 years, whatever it is. So we're getting more and more certainty. So I can start saying, what's the value of that company? So for example, Coca-Cola was like, what, $230 billion today, market cap. Could I buy that? Would I buy whatever the income stream is based off of that price tag? Probably not. I'm like, we're less than 2% dividend. Maybe not right now. But if Coca-Cola pulled back and all of a sudden it was on sale for 150 billion, like it really pulled back, and you're looking at it going, well, here's the dollars. Yeah, I'm going to buy that. And I'm not saying buy Coke or don't buy Coke. I'm just using it as an example. The stock market is full of these examples. The problem is that most people focus on companies that do not pay that out. And I don't know how, where they're getting their numbers from, but they're make-believe. And so I always say that is really risky business. I think Warren Buffett once said it really well, that when he first got started, he was looking around for soggy cigars that still had a puff in them. He was looking for little investments where he could get a little puff out of it, and then he'd sell it, right? And he says that's a really hard way to make a living. He'd rather buy companies that he's going to keep around for hundreds of years. He literally says that this is like your kids. You're buying really great companies. Why would you sell it? Would you sell your kids? I don't care if somebody came in and offered you a huge amount of money. There's just some things you wouldn't do. And the same thing is true in the stock market. When you buy good companies that are good revenue producers, you wouldn't get rid of them. So now we're looking at it in that lens. I'm looking for things that I'm going to keep forever. Now I'm looking at the revenue stream and the strength of the company. Now when we have dips, we can start valuing these things. The same way we value rental properties and real estate, we can start valuing stock companies in the stock market. We can say, hey, is this a company that I want to own? Is this a good price? Do I know what I'm going to receive? Am I getting as certain as possible? Like, am I narrowing it down saying, hey, you know what? I can be pretty sure this company is going to be here 10, 20, 30, 100 years in the future because this is what they do. I understand the economics of that business. It's continuing to grow, barring any major changes in technology or disruptions or things like that. We can pretty much say, hey, here's this, like Walmart. Hey, barring anything crazy, we kind of see what Walmart's doing. 3M, Procter & Gamble, Johnson & Johnson, like some of these companies we can just look at and say, here's what we can kind of see. Are they going to do they have do they have household names? Do they have things that we're definitely seeing? A company that I missed is like a Netflix, where they're not on my radar yet, but like when I was looking at it, I actually like that business model. It's a reoccurring revenue model. I was like, gosh, usually I am attracted to those types of things, but because there was uncertainty, I wasn't. But you're looking at companies like that. And I'm not telling you what to buy. I'm just saying is that when you can see them pull back and they go on sale, now you have a way of valuing it as opposed to just it pulled back because of emotion. You're going to see that a lot this next year in 2022. You're going to see that a lot because we don't know if they're going to be raising interest rates. We're assuming yes. The Fed has showed they're going to raise interest rates to combat inflation. Inflation's what pushes share prices up. And what really pushes share prices up of companies that are not based off of what they're paying out to the shareholders, it's this emotional exuberance. And quite often they're using credit to grow, like they're negative cash flow and they're not making profit, so they have to borrow, or they're using the markets to support themselves. If that's the case, those companies will get hit. We call them growth stocks, right? They're going to get hit kind of hard because money's going to get more expensive if what the Fed is saying is true. And you're going to see people get emotional about it, which is going to cause sways. We want to stick with companies that are unemotional, that, hey, they're making money now. They're not dependent on borrowing a ton of money to grow. They already have their market share. That market share is continuing to grow. Their revenue's been solid and stable for 3, 4, 5, 10 years, whatever it is. And they're going to be there. And what it does is it makes the market very small. And then it makes sense to go shopping when they're on sale. Last example I'll give you is like when there's a big, hey, Nordstrom's doing a semi-annual sale, right? There's certain things that you look at and they say there's a value to them. Like, I know the value of this particular brand or this particular shoes. And when they go on sale, 50%, you're like, that's really, really attractive to me. As opposed to going into a unknown store with unknown brands. I have no idea what the value is perceived for me or what the quality is, etc. And they just said everything's 50% off. And you're like, oh, I'm going to buy it because it's on sale. No, like, don't do that, right? They're very different. I'm not saying, again, go buy it, Norris. I'm just saying that quite often they'll have a better brand. Like, as a guy, I'll just say like Ferragamo shoes. I have shoes that are older than my daughter. My daughter's 24 now. It's like there's certain quality and you pay a higher price for that certain quality. And hey, if I can get it at a discount, boy, that's a really good deal because I'm going to have this forever. And you start applying that to the stock market and you start saying, here's good companies. I've always wanted to have that, and it's pulled back into a range and it's very predictable. And this is the revenue stream I'm going to get as a result of buying this. And what happens when the prices go down a little bit is those dividend yields go up, and you could start saying, boy, I've always wanted to get that. This seems to be a really fair price. I know what I'm going to be getting paid. It's going to get this nice dividend stream. I'm going to buy it. And guess what? Because I bought it at a good deal, it's worth more than I paid for it. Year, 2 years, 3 years. If something radically crazy changes in your world and you have to dump it, you're going to make money on that way too. But you also bought this beautiful income stream that's going to be with you for 100, 200 years if you decide to treat it like one of your kids and you won't sell it. So that's what I'm going to leave you with. Don't sell your kids. Anyway, if you like these types of videos, if you think they're helpful, share them with other people. like and subscribe.